Hello everyone and welcome to today's webinar. Today we are going to be talking about managing assets and debt through life changes. Now, as you may have attended some of our seminars previously, we're running a series of webinars across the 6 different pillars we cover from an advice perspective here at FMD. And for those of you that joined us last month, we talked around income and budgeting. And today we're going to be focusing on what to do with the surplus that you get and follow that on with superannuation insurance webinars in the future. For those of you who don't know me, my name is Nicola Beswick and I'm a senior advisor here at FMD. Today I'm joined with my colleague Anna.
Hi everyone, I'm Anna and as Nicola mentioned, I'll be doing the presentation on assets and debt today. For those who don't know me, I've been in the financial planning industry for over 15 years now, and I've recently returned from maternity leave, and it's been great to be back working with my clients and doing what I love.
Thanks, Anna. So a little bit of housekeeping before we get started. Today's session is being recorded and will be sent to you by email. So please feel free to watch it or share it with your family and friends. Anna and I do have some time at the end to talk through some questions that you may have. So please feel free to pop any questions in the Q&A function on your screen and we'll attend to them at the end. We will try and get to answer as many questions as possible, but if we don't answer them, we will get back to you with a response. Please, if you're having any technical difficulties, please refresh your browser and reconnect. And finally, like we have in the previous seminars, we will be sending out a brief survey at the end. We would really appreciate your feedback to ensure that what we do in the future is in line with your expectations and interests. And finally, a lot of the things we will be talking about today are general in nature. And so if you do have any specific questions around your situation, please reach out to your advisor. So just to recap on what we're going to be covering off today. Last time we talked a bit about cash flow and building a surplus. So today we want to talk about what to do with that surplus. But before we do that, we'll have a little bit of a touch on what's happened with asset values and debt levels over the COVID pandemic and where we are now. Look at, has this impacted the way in which we change our approach to building wealth? Look at some of the things that you can do around optimising both assets and debt to work in your favour, and summarising by finishing off how a financial planner can make a difference in your situation. So like we previously talked about, COVID has had an impact on people's income and expenses. And now that most of us are free, we're getting back to some normality. What this will mean is it really does looking at where you are and what life stage you are in terms of your income and expenses. Remember that everyone is different and you all have different needs and in different situations, but it's really key to look at what you may do with any surplus that you have or the wealth that you currently have at the moment. But firstly, let's look at what's happened throughout the the pandemic and what COVID has had from an impact on asset and debt values. I'll hand over to Anna to take you through this.
Great. Thanks, Nicola. So, over the next few slides, we're going to look at what has happened with equity markets, property prices, debt levels, and superannuation. So firstly, looking at equity markets, as you all know, due to the pandemic in March 2020, we saw equity markets fall by 30%, And at this time, the world was imploding, there were recessions everywhere, and myself, Nicola, and the other FMD advisors were having a lot of conversations with our clients, as understandably the unknown and uncertainty was having a big impact on people's emotions. But since then, we've seen the equity markets have rebounded strongly, as you can see in the circled column on this slide, which shows the increase in equity markets for the last 12 months. And the main factors contributing to this performance is really due to governments pumping money into the economies to create stimulus. Low interest rates have increased the demand for equities as people are trying to generate a higher return. And the low interest rates have also reduced debt servicing for households and businesses. And people are wealthier and they have more savings. And this is creating consumer and business confidence. Now looking at the property market, as this graph shows, as you all know, we've also seen a big increase in property prices. So although we did see a dip around mid last year in the property prices, that was due to the initial lockdowns, but the average residential property prices have since increased by about 20% for the last 12 months. And as we know, the property price increases have not only been in capital cities, but also regional areas due to the desire to escape the city and for lifestyle changes. The gains have really been driven by record low mortgage rates, low supply of properties, government buyer incentives as part of the stimulus, and people wanting more space as a result of working from home. Now, if you look at debt, we can see here, so although total debt has increased, we can see in this graph that household interest payments as a share of income is currently the lowest it's been since the mid-1980s. However, household debt to income ratios are currently high, which could potentially create a problem at some point. But we have seen recently the RBA and APRA come out and warn that more restrictions on lending are on the way to try and take some of the heat out of the market. They have said that banks will be forced to use more cautious interest rate assumptions for new customers, and we've actually already seen some banks start to tighten lending. And this is all expected to reduce borrowing capacity by around 5% and will most likely have an impact on property and take some of that heat out. Looking at the impact on superannuation, we can see, so even with the withdrawals made via the early access to super scheme as part of the COVID-19 stimulus measures, we've still seen nearly a 15% increase in superannuation to the year ending June 2021, as you can see here. So superannuation contributions and strong investment performance have contributed to this, as well as the government measures to halve the minimum requirements that people are required to withdraw from their superannuation pension accounts, which some of you might have done. So as you can see, what we've just gone through, equity markets and property prices are currently at all-time highs, but we know that this isn't going to last forever, and it's hard to predict what the market's going to do. So now I'll hand back over to Nicola to take you through if there has been a change to the way we approach building wealth as a result of the pandemic.
Thanks, Anna. It's an interesting question. Has the pandemic changed the way in which we've approached building wealth, particularly on some of those factors that Anna suggested? I think the answer really is unlikely. The key thing is really making sure that you've got a really clear understanding around what it is that you're trying to achieve and looking at how you go about achieving building wealth. One of the key things that I will talk about now in this slide or section is about the different structures that we have in order to house wealth. This is particularly important before you even look at the type of assets that you want to invest in. And some of the key things that are important when we look at these different types of structures is the 6 points that I've got there on the slide. Tax effectiveness of the structures, what are the estate planning consequences of each of those structures, as well as potential risk factors, asset protection and control, particularly when you look at what your choices are. And the final point, income. This is particularly important for a lot of those of you who are listening today and are thinking about age pension entitlements. It's a very key part of what our decisions are as well. So a high-level overview of some of the main structures that we see in the toolbox that we have when planning for people's wealth accumulation or wealth maintenance, depending on your life stage, are these ones here. We've got individuals, so holding assets in your own name. Company structures, so holding an asset via a company structure. Partnerships, which are essentially very similar to individual structures, depending on the setup. Superannuation, which is the big one that I know pretty much everyone listening today will be aware of or have at least one super fund. And this will either be in what we call the accumulation phase or the pension phase. And finally, we've got trusts. So superannuation is a form of a trust, but you've also got things like family trusts, etc., that you can use to house wealth and accumulate over time. So looking firstly at the tax effectiveness of each of these different structures, this is actually really important when you want to look at what you're wanting your money to do and how you want to access it in the future. Tax is always one of these key things that we always get asked about, and it's important to understand this. If we look at the different types of structures that we've got here, this really explains it at a high level. We've got individual tax rates, which we know is your marginal tax rate on a sliding scale, depending on the level of assessable income you have. We've got trusts, which essentially the tax on them is essentially flows through to the individual or company beneficiaries and taxed accordingly based on that recipient. Then we've also got company structures, which have a flat rate of 30% or 27.5%, depending on your turnover. And then we've got superannuation, and you can see by far superannuation is one of the most generous from a tax perspective, and is why a lot of people like using this structure to house their wealth. Accumulation from an income perspective is taxed up to 15%, and in the pension phase is taxed at 0%. When we have a look at capital gains, so very different to any income you receive from an asset, this is also taxed in different ways through each of those structures as well. And it's really important to think about what it is that you're going to be investing in, and when you may need access to some of this money, because we know for some of us where we can't access superannuation for another 20 years or so, it's not as great to have it from an accessibility perspective if you need money in the short term compared to the long term, even though the tax rates are beneficial. I'll use a couple of examples in the next couple of slides to really solidify what I mean by this compared to the different structures. So the first example I've got here is looking at an asset housed within each of these different structures that generates a small amount of income, but potentially high level of capital gains. And what I'll do is draw your attention to the first column on the left-hand side, which has the individual tax rates there. You can see this is assuming that the person's at the highest marginal tax rate and not the lowest. And you can see if the asset has an income of $70 a year compared to a capital gain of $440 a year. If we crystallise that investment and realise that gain, the gain is discounted by half, which is that $220. The amount of assessable taxable income is the combination of that capital gains discount plus the income, which means taxed at 47 cents in the dollar, you end up with a net profit or net proceeds of $374. Now, if we compare this to the other end of the spectrum with superannuation in the accumulation phase, we've got set tax rates there. Tax rate from an income perspective is 15 cents. So looking at the same amount of income and capital gains as we did with the individuals, you can see the amount of taxable income is very different, but the tax paid is very low as well when compared. So this ends up with a higher amount of wealth left upon crystallization of this type of investment compared to individual and potentially company and trust structures. But if we compare this to an investment that has a high income level and a low potential for capital gains, again, using the same logic, you can see the individual, assuming again that they're on the highest marginal tax rate, and this may be different for someone that is on a lower tax rate, the next proceeds are nowhere near as generous as what would be accumulated within a superannuation accumulation account. And then when you look at company and trust structures, you can see the difference as well. Now, bear in mind with the trust structure in this example, the money has flowed through to a beneficiary and also taxed at their marginal tax rate as well. So that's where that tax rate of 34.5% has come from. With capital gains, particularly when we're accumulating wealth, is one of the key aspects of what we're looking at. And I think this table really brings home the point around that net result from a tax perspective. Again, comparing the two ends of the spectrum, so an individual to a superannuation in the accumulation phase, you can see the difference there in terms of the net proceeds that you've got, particularly when we just focus on the amount of capital gains that may be there. So it highlights the point that each different structure has different types of tax treatments, but it really depends on a whole range of other factors that are important for consideration as well when making sure we get the right asset structure. The second thing that I highlighted, which is also very important from an asset perspective and where you house your wealth, is the estate planning consequences. Now, we will touch on again this a little bit, but broad overview, any assets held in a person's individual name are generally dealt with in someone's will. So it's very important to make sure that you have your estate planning affairs in order. Superannuation, on the other hand, you essentially are giving the trustees a decision-making capabilities because they're the people that make decisions on your behalf. Now, if you don't give them instructions, they will make those decisions on your behalf, but you can actually give direction to them through the use of superannuation nominations or reversionary pension nominations. Again, really important tools to make sure that you've got covered off. And we will be talking about that in a little bit more detail and the consequences of each of that in the superannuation webinar that we'll talk about coming up. We also have trusts and companies. They're a little bit more complicated in terms of the estate planning consequences and what you have to be take into consideration. But trusts are really, I guess, important to highlight because it is the trustees that have the ability to make those directions, very similar to superannuation, being also a form of trust structure, but also the appointer of a trust. So many trusts have this person set up, and they are essentially the controlling person of a structure or a trust structure. So it's really important to make sure that you understand that and the consequences. And finally, the third point that a lot of people ask around what structure to house wealth and making sure they're taking the most out of everything is Centrelink, particularly when we get to age pension. Now, those of you that are on the call will know that there are essentially two main tests that determine whether you're eligible for Centrelink. That's the asset test and the income test. And assets are particularly treated differently under each of those tests, depending on what they are. So, for example, I've got a couple of points here on this slide. The principal home, regardless of whether it's in your own name or a person's individual name, is an exempt asset. Now, it does be a little bit more trickier if it's held through another structure like a company or a trust, but generally that's very uncommon. Cash and investments are essentially dollar for dollar. But then when we start looking at other structures like trusts, it depends on the structure and the control. And superannuation, which again is the most common form of which we see people housing wealth, it's counted dependent on a couple of things: your age, or whether the superannuation is an accumulation or not. So regardless of your age, if you're over age pension age, it's counted regardless of whether you're in accumulation or pension. Compared this to whether you're under age pension age. And also the income test. This is particularly important because some assets have a notional assumed amount that they earn, like investments in your personal name and cash, but things like investment properties are very different. They look at the rent you receive, not an assumed amount. So all the really exciting things that we get to look at before we even get to the fundamental stage of investing your money in particular investments. I'll now touch on, I'll now hand over to Anna, who will now talk about how to optimise both assets and debt to work in your favour.
Great, thank you, Nicola. So I guess trying to get the most out of your assets and debt depends on what stage of life you're at. So we've broken this part up into different life stages, so retirees and accumulators. And so given current low interest rates, those nearing retirement or those who have already retired can't currently rely on cash or term deposits to generate income. Back when interest rates were 7 or 8%, if someone had $1 million, they could invest in a term deposit and live off that investment, live off that interest of around $80,000 per annum, and not have to rely on and not having to touch capital. And just the $1 million just stays as is. But in the current environment, people are having to take on a bit more risk and invest in growth asset classes, or what's considered more risky asset classes, such as Australian shares, international shares, and property, if they want to generate a higher return and get more income and growth from their investments. In terms of taxation, as Nicola mentioned a little bit earlier, just before, the best vehicle to invest for this life stage is superannuation, as it's entirely tax-free. And obviously it depends on your circumstances, but most of the time it is the best vehicle to invest in. Something else to note is that you buy a superannuation, you still have full access to all investment options, so all different investments, direct shares, managed funds, all types of different investments via a superannuation account, the same that you would have in a personal investment account. The only difference is just the tax structure of it. And as superannuation pension is entirely tax-free, there are contribution and age limits on getting money into superannuation. And therefore, usually planning for this needs to take place around 5 to 10 years before retirement. There is currently another way that you can get money into superannuation, which is via the downsizing contributions, which was introduced in 2018. This allows people to contribute some of their home proceeds into superannuation. But there is criteria that you do need to meet in order to be eligible. And we have the main criteria listed here, which is that you need to be at least 65 years old and you need to have owned your home for a minimum of 10 years. The other thing to note is the maximum you can contribute is $300,000 per person or per individual, or $600,000 for a couple. Something else also that we do sometimes get questions about is, do you actually have to downsize your home in order to be eligible for this? And you don't. So although it's called the downsizer contribution, you don't actually need to downsize your home, and you actually don't need to even purchase another home. So you're still eligible if you sell your home. You're still eligible to make the downsizer contributions. So the main benefits of the downsizer contribution is it's an after-tax contribution, and therefore there's no tax when the contribution is made. And as mentioned earlier, the contribution will be invested in the tax-free pension environment, and you also have full access to that money as well, because you have full access to the superannuation pension account. And as listed here on this slide, we have a simple example here. So if we exclude buying and selling costs and assume that a 75-year-old couple sells their home for $1.7 million, buy another home for $1.1 million, they can then contribute, and they meet all the criteria, they can contribute their entire excess proceeds of $600,000, so $300,000 each, into superannuation via the downsizing contributions. I will just note, though, that any excess proceeds, so $600,000 in the example that we just went through then, will be counted towards the Centrelink income and asset test. And therefore, if you receive Centrelink entitlements before selling your home and you have excess proceeds, then this will impact your Centrelink entitlements. So it's just something to be mindful of if you're thinking of doing this. So now looking at accumulators, generally at this life stage, you usually have a lot of debt and you're not usually focusing on retirement yet. So strategies that can potentially help with wealth creation and debt reduction in this life stage can be gearing and debt recycling. So negative gearing strategies can be worthwhile for those on high marginal tax rate due to the tax deduction on the interest loan repayments that you get. On top of gearing, you can also apply what's called a debt recycling strategy, which can help turn bad debt, so such as mortgage, because it's non-deductible debt, into good debt. So that's what we refer to as tax-deductible debt. So as shown in the chart here on this slide, the debt recycling strategy works by using investment income from an investment portfolio, so such as dividends and distributions, to reduce your mortgage. So you take the income from the investment portfolio, put it on your mortgage, and then you can borrow against the increased equity to invest back into the geared portfolio. So basically, the compounding effect of these strategies, so gearing and debt recycling, can be powerful because you're able to reduce your non-deductible debt, or what we call bad debt, whilst also increasing your personal investment assets, so that wealth creation asset side. And obviously what I'm going through right now is for a geared investment portfolio, but the same concept can apply for a geared investment property as well. So hopefully that gives a brief summary of how to best use assets and debt depending on your life stage, just a couple of examples. And now I'll hand back to Nicola to take you through how professional advice can make a difference.
Thanks, Anna. So one of the key things when we first look at people's situation with our financial planner lens on is really looking at what specific factors are within your situation and really touching on your goals and what you're wanting to use that money for. Well, some investment structures may be great from a tax perspective. They do have other kind of complications that you need to be aware of, and this could impact your planned ideas around some of the money that you're either accumulating or accumulated. So it's really important to get that right, as well as understand how you want to be invested, particularly from the different types of asset classes that exist and the return profiles that we see. It's all about taking a particular level of risk with the money that you're willing to take and making sure that what you have currently in place is working towards what you're looking at for you and your goals. And that is always the question we ask, regardless of whether it's a new meeting or an ongoing meeting. Are these things working for you? So once we've decided what type of structure to invest in, it's looking at what or how to invest that money. And this is where we look at these specific different types of asset classes and what their returns can potentially be. Generally, you've got a range of different asset classes here. We've got cash and fixed interest, so very much you did what we call defensive assets, compared to your what we call growth assets, which are your Australian shares, international shares, property, infrastructure, etc. So each of these different asset classes have different return profiles, and depending on, again, coming back to that initial question of what is the money for, will dictate how you invest, and particularly in these type of portfolio overlays. So for someone who may not want money straight away and want to grow their money, a high growth portfolio, so what we can see on the right hand side there, where we're essentially 100% in shares and property with no cash or fixed interest, can be very appropriate. Again, what we will see is quite a high level of volatility, but also potentially a high return. You compare this to something that's on the other end of the spectrum, so a conservative portfolio where we very much have a large portion of wealth in the cash and fixed interest buckets. Now, this gives us a really good level of stability and not a reasonable sense of comfort around what will be in the future in terms of that wealth. So particularly if you're looking for something in the short term, this could be particularly useful to use. But each different portfolio, asset class, structure has different types of consequences in terms of capital growth, the amount of income you receive, and whether they're franked or unfranked income. So very much Australian shares versus international shares, and looking at that. Particularly, I know a lot of people like that franking credit that they get back because it's getting a refund of tax, which it's a bit like Centrelink, everyone quite likes. So that is going from where to invest in terms of the structure to how to invest in terms of the different types of assets and what you could look at. We haven't gone into specific investments. That's a webinar for the investment committee, and I know that they produce a lot of those for you. But some of the key things to also bear in mind is making sure that you do cut through the noise, particularly when we have the disruptions to investment markets, like Anna highlighted earlier with what we've seen in equity markets and the returns. This is a really neat graph that I think really represents some of the decisions and the emotions that we go through for volatile times. Now, this is an example of someone going through the GFC, and you can see staying the course in the light blue line compared to cashing out at the bottom of the market and not getting back in. That's the green line where money is just retained in cash. And then we've got somewhere in between where people get back into the market. That's that dark blue line, and you can very much see the difference. So it's actually a really powerful chart to see in terms of getting through that noise, particularly in those volatile times. In this chart here, which also illustrates the point, but specific asset classes, really comes back to that key point around diversifying where your money is. We never know which asset's going to perform the best or the worst in any given year. And this chart here very much summarises what equities in the green, bonds in the yellow, and private markets and commodities in the red have done over those different periods of time. Now, these are annualized numbers, so not financial year, but it really does illustrate the different variations that we do see and why we need to get some level of diversification across the classes. So that brings us to the end of our presentation today. And just to recap, what we've gone through is we have seen COVID-19 impact all asset classes, but we have had a really good recovery. And one of the things to remember is there are those different types of structures that we can have in terms of where to hold your money and how to invest it. Each have pros and cons associated with them, so it's really important to make sure that you understand what those are first before you decide to purchase a specific investment. And remember that not all debt is necessarily bad, and that you can, depending on your risk appetite, use this to generate further wealth, but you need to understand the risks for yourself and the long term. Next time, we'll touch on superannuation specifically in more detail, again, because this is very much a really large part of people's wealth profile and something that's very important to understand. Now, we do have time for some questions, and I can see that we do have one question in the box there. So the question is, if I have 1.7 million in super and not retired, if I put other cash in assets, do they get taxed at 15%, and should I put them in up to the cap in super and I'm not retired? If I put cash assets, do they get taxed? So I think your question there is very much, if you put money into superannuation, do you keep tax the 15% as a contributions tax? Yes. Now, the question around should you put them in up to the cap, I think that is dependent on your specific situation, and I would strongly suggest that you get some advice around that, because it's one of those, it depends on what your situation is as to what may be the right thing for you. I'm not sure, Anna, if you want to add anything more to that.
I'll just say, so in terms of the tax on contribution, it depends on the contribution type that you're making. So if it's what I was referring to earlier for the downsizing contribution, that's what's called an after-tax contribution, so a non-concessional contribution. When you make those contributions, so if you have cash, which I think so if you've got cash in your name and you've already paid income tax on it and it's savings, if you contribute that, it's after tax. Okay, great. So if it's after tax, then no, there's no, the 15% contribution tax, you won't incur that, or the super fund won't incur that. The 15% is only on concessional contributions. So superannuation guarantee contributions or salary sacrifice contributions. But money you make with non-concessional is there's no contribution tax on that. But you just need to be mindful of contribution caps. So because there are certain contribution caps that you can't exceed.
Great. That was good question there. Now, does anyone else have any more questions they'd like to ask us?
Yeah, it was a great question.
No more questions coming through from the audience.
So I guess, Nicola, some questions I get from clients is they want to know how to help their children. Yep. So I don't know if you get this question as well, and I don't know what advice you give around that.
So it's one question that does come up quite a lot, particularly as we see a lot of people trying to get into the property market and wonder around how their children might be able to do that, or how they may want to invest some of the money that they have. The answer to that very much does come back to, if someone's accumulated money and they're not quite sure what to do, then it's about going back to what they want to do in the future. So coming back and asking that question around what someone's goals and objectives are, that's particularly important to start with. And then you can start making some specific answers and decisions around where to put the money and how to structure it, whether it's something for the short term. So if it's money for a property, you want to be something a little bit more conservative if it's going to be something in the short term compared to something that may be long term. So you can be a little bit potentially more aggressive with that. But again, it really just depends on what the specific situation is.
Yeah, 100%. And I think, because of the investment timeframes for those growth investments, usually we need at least kind of 5 to 7+ years. So if someone is saving for a house and, as you said, planning to do that in the next 1 to 2 years, then it kind of limits the options on what we can do with that.
Yeah.
100%. Yeah, great.
I don't think we have any more questions. So I'd like to say thank you for joining us today. Remember, we will be sending out that survey to you afterwards. And also, please, if you have time, join us for our next webinar, which is scheduled for next year now, to talk about superannuation in more detail.